Welcome to Advanced Tax Planning Strategies for Financial Planners, presented by Lawrence Pond. Lawrence is a certified financial planner, certified public accountant, personal financial specialist, and accredited estate planner in Redwood Shores, California. He has been practicing since 1986 and provides the latest advanced tax and financial planning strategies to financial planners so they can be knowledgeable with their clients. Lawrence received his bachelor's in business administration from the University of California, Berkeley, and master's in taxation from Golden Gate University in San Francisco. He is a longtime member of the Financial Planning Association and speaks frequently to the San Francisco and Silicon Valley FPA chapters.
Hello, this is Larry Pond, and thank you for the honor to speak to you today about advanced tax planning strategies for financial planners. I've been in the tax world for the last 34 years, and I don't think I've seen as many changes in the tax world as we've seen in the last few months. So I was trying to think of what topics to cover in today's session. And so the topics we're going to cover today is Roth conversions, because I think 2020 is the year for Roth conversions. We had so many things happen this year. We had the CARES Act, we had market volatility, we had the Secure Act. Unfortunately, we have a lot of our clients having tough financial times, or our business clients having significant challenges, which these challenges will give us opportunities for Roth conversions. Also, we'll talk about backdoor Roth conversions, the mega backdoor Roth, and other considerations. And at the end, we'll have some time for some Q&A. So I look forward to talking to you directly then. So why is 2020 the year for Roth conversions? First of all, we had the enactment of the CARES Act, which passed in March of this year as a result of the coronavirus pandemic. And significantly of those changes, the CARES Act has increased the charitable contribution limits. It's suspended RMDs. And we're talking about RMDs for IRAs and inherited IRAs and retirement plans, defined contribution plans. And the CARES Act also expanded the amount that can be utilized with net operating losses. The other significant change came in December of last year. First time since 2006, we had big changes to the retirement plans in the Secure Act. So most significantly, no more stretch IRA. And we'll talk about why a Roth conversion is going to help counteract that negative change there. And also, we've had some market volatility this year. So Roth conversions could be very useful against market volatility. So first of all, let's talk about the advantage of a Roth IRA. The first most significant advantage is the growth is tax exempt, tax free. So there's no tax on any growth in a Roth IRA. So for example, I funded a Roth for my son. He's been working. He was a high school student. Now he's going to start college. And at 18 years old, there's a lot of time for tax-free growth. So, and also his tax liability is zero. So perfect candidate. He's got all the time in the world for that money to grow tax-free. The advantage a Roth IRA has over a traditional IRA, of course, is there's no required minimum distributions. So which type of accounts can you convert from a Roth? You can convert traditional IRAs, 401k plans, profit sharing plans, 403b and 457 plans. So you can convert those type of accounts into Roth IRAs. Now, the type of accounts that you cannot convert to a Roth IRA are inherited IRAs and education IRAs. Those cannot be converted to a Roth. So what's the disadvantage of a Roth IRA? Well, the first disadvantage is that it is funded with an after-tax contribution. So the money that's going into a Roth has been taxed already. But the disadvantage might not be that big of a disadvantage if the client or taxpayers at a 0% tax bracket, such as my son. If you do a Roth conversion, there could be a tax due. So that's a disadvantage of a Roth IRA. You have to pay some tax on the Roth conversion. Of course, that's where tax planning comes into play. If you want to fund the Roth IRA, there are income eligibility restrictions. So if your income's too high, you're not eligible to contribute to a Roth IRA. And just like a traditional IRA, there are penalties for early withdrawals. If you take out before age 59 and a half, or any of the allowed reasons to take money from a Roth IRA, there could be some penalties. And depending on the trustee of the Roth IRA, there could be some investment restrictions. There are certain type of securities you can or cannot invest in, or certain assets. So that could be a disadvantage to a Roth IRA. Why do we want to do a Roth conversion? Well, you take a look at the impact on taxation of Social Security benefits. So a lot of times we recommend to our clients, let's do these Roth conversions before you start your Social Security. So for example, if your client wants to delay their Social Security until age 70, well, before age 70, we might want to do some math and do some Roth conversions. So when it's time for them to take the required minimum distributions, it doesn't push more of their Social Security to be taxable. Also, there's an impact on Medicare Part B premiums. The higher your income, the higher the premium. So it might make sense to do these Roth conversions before you start taking the Social Security, which could reduce the amount of Medicare premiums. The also thing we should look at also is the tax rates for married couples versus single individuals. So this would be an example of a retired client. Their income is not going to change possibly if one spouse passes away. However, in the subsequent year after that spouse passes away, the surviving spouse is now subject to the individual rates, which could be a higher tax bracket than if they were married filing jointly. So it might make sense to do some Roth conversions while you still have the two spouses, where we can take advantage of the married filing jointly tables versus the single tables consideration and think about. Now, the hot topic we have now is, what are the future tax rates? Well, we know right now that in 2026, the tax rates will go up because that's when the Tax Cut and Jobs Act, TCJA, that was enacted at the end of 2017, when it will expire. So we'll know that the tax rates go back up in 2026 for sure. We know about that. Will it go up sooner? Who knows? Depends if there's a change in administration or change in the houses of Congress. So we'll see what happens. But most tax commentators think there will be an increase in taxes. Also, another reason for a Roth conversion is we can calculate the right amount to convert, able to avoid the 3.8% Medicare surtax, also known as the net investment income tax, or NIIT. So those are some considerations to think about for Roth conversions. Here's a quick slide on the taxability of Social Security. So 50% of the Social Security benefit is taxable if your income's over $25,000 if you're single, or $32,000 if married filing jointly. If your income is over $34,000 if you're single, or $44,000 if you're married, 85% of your Social Security will be taxable. So that's a consideration to think about, because for some of our clients, sometimes an extra dollar of income, $1 of income, could be a 150% increase in tax, because not only are you paying tax on that income, you're pushing that Social Security benefit to be taxable. So we'll have to take a look at our clients' taxable income situations. Now, it's modified adjusted gross income. So what does that mean? That also includes tax exempt income. So if you have your clients all on tax exempts, even though it's not taxable, it's considered as adjusted gross income for Social Security taxation purposes. Here's a quick slide on the Medicare premiums. So if your clients are individuals and their income is less than $87,000, or if they're married, $174,000, their Part B premium is $144.60 a month. However, if their income goes up, so let's look at the extreme at the bottom of the table here, $500,000 if you're single, $750,000 if you're married filing jointly, the premium nearly quadruples to $491.60. That happens to our clients sometimes because of a sale of their home or a large capital gain. So for a year, they're going to be paying the higher Medicare premiums. So if there's a large transaction that a client's encounter, we need to give them a heads up because they tend to get upset when they find out that a chunk of their Social Security benefit is going towards a higher Medicare premium. So that's part of the planning consideration and think about. Here's a summary of the 2020 tax brackets under the current law. So take a look at let's take a look at the middle here, the 24% bracket. If you're single, it's between 85,000 and 163,000 if you're single. However, if you're married filing jointly, that goes from 171 to $326,000. So the brackets are definitely more favorable for married filing jointly, especially for retired clients. So that could be a good consideration to think about for a Roth conversion, because you never know when your client is going to be widowed or widowered. So, because of these brackets. So something to consider for planning purposes here. All right, additional reasons for Roth conversions. So many of our clients are very generous, and under the old law before the Tax Cut and Jobs Act, you can deduct up to 50% of your adjusted gross income when you give to charity. And a lot of our clients are very generous, so they exceed that limit. Under the Tax Cut and Jobs Act, that's been increased to 60%. And now the CARES Act, which we'll talk about later here, is now 100% of adjusted gross income for cash contributions. But we might have some clients with some charitable deduction carryovers. It's a 5-year carryover, and we don't want that to expire. NOL carryovers, net operating losses. So they might have losses being carried over. Now, the CARES Act has undone what the Tax Cut and Jobs Act did, which means you can carry it back 5 years instead of just carrying it forward. However, instead of carrying it back, maybe that'll give us an opportunity to do a Roth conversion to offset the net operating loss. So an example I have is a client that she's got $1 million in her IRA account. She's got $1 million in her IRA account, and that's going to be spread among her children and grandchildren. So they'll have to pay tax on that. So I was doing some planning. She's gone to hospice, and she's gone out of hospice. So we don't know how long she's going to be with us. So we did some math. She had some losses, and I did some math. I told the daughter, let's do $160,000 of Roth conversion this year. So that took $160,000 out of that $1 million traditional IRA, converted to Roth. It didn't really cost her much because she had losses and carryovers and all that. So that was pretty good. So now the beneficiaries will have $160,000 in a Roth IRA, which would be tax-free to the beneficiaries. And we'll talk about more about the Roth IRAs later, about the benefit of that. Your clients might have some high basis non-deductible IRAs. So maybe they've been contributing to these non-deductible IRAs. High basis, it means it probably won't cost that much if we do a conversion. So those are great assets to do a Roth conversion. 2020 has been a really rough year. We've had many clients who are really suffering. Our restaurant clients, our bar clients, our hospitality clients. I have a client that sells cruises. You can imagine what their income looks like this year. It's negative. It's negative because they had to return nearly all their commissions for 2020, 21, even 2022. Many of their clients are canceling on them. Sadly, we know what their taxes are this year, but they're a great candidate for a Roth conversion because they're not going to be paying very much tax. So take a look at your clients who have business losses this year. They'll be good candidates for a Roth conversion to soak up those lower tax brackets, like that tax table I showed earlier. We can take advantage of the 10% bracket or the 12% bracket when they're normally in the 24% bracket or 35% bracket. So take advantage of those lower brackets. Alternative minimum tax could be another reason. The Tax Cut and Jobs Act did not eliminate the AMT for our individual taxpayers, but increased the premium, the exemption. But your client might have some AMT credit carryovers. So doing a Roth conversion might help unlock some of those carryovers. So that could be used. Credit carryovers is another reason. Examples would be clients who have very low tax liability, and they bought an electric car. They got a $7,500 tax credit. You can't use it if your tax liability is zero, so that it gets carried over. So some of these credits get carried over, like the solar energy credit for a home. So a lot of clients get these credits. They expect they'll get a big refund, and then a tax guy like me will have to deliver the bad news saying, sorry, they're what's called non-refundable credits, which means is only used to offset your tax liability. So we can increase your client's tax liability by doing a Roth conversion to be able to soak up these credits. So nothing worse than wasting a tax credit. So those are worth looking at. Those are the two main ones I can think of. There are other credits. So we take a look at a client's tax return to see if they have any credit carryovers and see if a Roth conversion would unlock them. We can unlock a lot of money for a client. So let's talk about the CARES Act here. So what the CARES Act did was for 2020, the 60% limit on charitable contributions has been eliminated. Now the limit's 100% of your adjusted gross income. And that could give us a Roth conversion opportunity. So for example, let's say Joe has $100,000 of adjusted gross income, and he wants to make a cash contribution of $100,000. And under the CARES Act, he can fully take that, but it really takes his taxable income to a negative number. So what about the standard deduction? What about tax bracket management? Does it really make sense to have him at the 0% tax bracket? Maybe not. We should have him pay some tax, which means, let's say his normal tax bracket's in the 22% bracket. So we can do a Roth conversion to get him there to the 22% bracket or lower, or we can play with the Social Security calculation to optimize the situation. I'm never a believer in just because your taxes are zero, that means you're doing smart tax planning. Maybe you're wasting those lower brackets. So let's take good use of those. The other big thing the CARES Act did was the suspended required minimum distributions. And that was frustrating for a tax person like me because that law passed on March 27th. Well, we met a lot of clients already before then. A lot of clients have their RMDs scheduled in January. It's automatic. So a lot of them took the RMDs. Well, the IRS told us that if they took their RMDs, they had until August 31st to return them so it won't be taxable. So a hint for you is take a look at your clients' RMDs. Many of them might not have taken them yet for 2020. It might not make sense to take it for 2020. Why pay the tax if you don't need to? Also, a lot of people have their RMDs programmed for December 1st. So you might want to check the computer to make sure it doesn't happen automatically. So take a look at your client's RMDs. This is the year of the skipped RMD. So let's do that. That applies to retirement plans, 401ks, 403bs, 457, traditional IRAs, inherited IRAs. So with regard to the suspended RMD thing, normally we have clients that take the RMD and they want to convert it to a Roth IRA. And I said, no, don't. You can't do that. You're not allowed to do that. But for 2020, since you can quote unquote take the RMD and convert it to a Roth because they're not technically RMDs. What's the advantage of doing that? That can reduce the future RMD because you just took that out of the traditional IRA. And again, you're reducing the income tax to the beneficiary by moving some of that traditional IRA money to a Roth IRA. So that could work out really well for our clients. So normally you can't convert RMDs to Roth IRAs. So since there's no RMDs, you can take the RMD and put in a Roth. So that could be pretty helpful here. So which RMDs are suspended for 2020? IRAs, defined contribution plans, 401ks, 403b, 457. Most importantly, inherited IRAs. So that gives you an extra year in there to let it grow tax deferred. That can work out pretty well. What's not suspended? Defined benefit plans. So those are the pension plans, the cash benefit plans. So those don't stop. The non-governmental 457 plans, those are generous or nonprofits. Those are not suspended. Any annuitized annuities are inside IRAs, 401ks, 403b, or other retirement plans. If it's already annuitized, those cannot be suspended. And if we have clients doing what's called 72T distributions, which means they started distributions from their retirement account before age 59 and a half, also known as substantially equal periodic payments, those have not been suspended. So those still continue. Now, the suspension of RMDs apply to taxpayers who reached 72 in 2020 because the Secure Act increased the RMD age to age 72. Taxpayers are 70 and a half prior to 2019. Here's the lucky ones here. Taxpayers reaching age 70 and a half prior to December 31, 2019. Those are the people that said, okay, I turned 70 and a half in 19. I'll delay my RMD until April 1st of 2020. And I'll take my second distribution by December 31st of 2020. Those people lucked out. So instead of that double distribution in 2020, it's zero. What a deal. What a deal. And that changed a lot of my tax planning for a lot of clients. So it really significantly lowered their tax bill. So what if you already took your RMD in 2020? You can complete the rollover by August 31st. So hopefully we took advantage of that. It doesn't have to be back in the same account, and it doesn't count towards the once every 12-month rollover rule. Thank you, IRS Notice 2020-51. So the CARES Act also repealed the taxable income limitations for net operating losses. So for 2020, you could take an annual deduction equal to 100% of your taxable income. Before the CARES Act, it was only 80%. So we can do that. But do we really want to? Well, that gives us a chance to take advantage of lower tax brackets to do a Roth conversion. So for after 2021, you still get the 100% deduction for NOLs that were created before 2018, but starting in 2021, it's back to 80% limit again for any NOLs that started in 2018 or later. So more opportunities for Roth conversions. Secure Act now. What did the Secure Act do? It took away the stretch IRA. What that means, if you inherit an IRA, you've got to distribute it within 10 years. And that applies to traditional IRAs and Roth IRAs. So that's a concern for many taxpayers, because instead of stretching over your life expectancy, it's got to be distributed in 10 years. So that could mean that we might want to push more into the Roth, because that'll be tax-free to the beneficiary. So here's the big benefit of the Roth. Even though it's subject to the 10%, 10-year distribution, you can hold it for 10 years, not take any distribution, and then cash out. That's going to give you 10 years of tax-free growth. So we would love to see our beneficiaries take advantage of it, not just empty the account the year they get it. There are 4 individuals are still allowed to use the stretch IRA. They're known as eligible designated beneficiaries. That's the surviving spouse, a child who has not reached age of majority. Now, the age of majority is based on your state law. So look up what your age of majority is in your state. Now, this applies to a child of a parent. So not a grandparent, an uncle, or whatever. So it's only parent, child. And what that means is if a child inherits an IRA, while the child is still a minor and not the age of majority yet, the distribution is based upon that child's life expectancy. Now, it could be extended up to age 26 if the child is a full-time student. The third category would be chronically ill individuals or disabled individuals, and individuals who are not more than 10 years younger, or that could be someone older. So that's generally could be a sibling, a friend, or someone like that. So those 4 people still get the stretch IRAs. Now, the 10-year rule, the rules of that is similar to the current 5-year rule for non-designated beneficiaries. So what that means is it must be distributed within the 10-year period. So you have some flexibility on the distributions. You don't have to take it every year during the 10 years. And it depends on the beneficiary's tax situation. So you want to review their tax brackets, and you might want to take a heavier distribution when they're in their lower tax brackets. So for example, if the beneficiary is younger, lower earning years, you might want to take heavier distributions, especially if you expect that the beneficiary will be in a higher tax bracket or a higher income. So as long as the account is emptied within the 10 years. So that's the 10-year rule on that. So the Secure Act also increased the RMD age. Now it's age 72 instead of 70 and a half. So that makes it easier for me to count instead of figuring out what that age 70 and a half age is. So it's age 72. And if you do the math, it's for people who are born after June 30th of 1949. So if your clients are born after June 30th of 1949, the RMDs don't have to start until they turn age 72, and they can push that out to April 1st in the year after they turn 72. So in the year they turn 73, they take one distribution by April 1st and the second one by December 31st. So this could give us some incentive since we have some time before we have to take a distribution. We have 2 extra years now. It might make some sense to do some Roth conversion before age 72 to reduce the RMD and get more for the beneficiaries in a Roth IRA. So this extra time could be helpful there. Now, what about stock market volatility? We saw a little bit of that in the first quarter of this year. So take a look at the portfolio for securities that dropped in value. So if it's in the traditional IRA, you might do a conversion when the security is down, convert that to a Roth IRA, and when the market recovers, boom, you have tax-free growth. What a deal. So an example would be I've got $80,000 of ETFs and stock positions. It's down to $80,000, but let's say the market recovers, it's back to $100,000 where it was in February of 2020. You just made $20,000 tax-free. That's a pretty good deal. So I went to take a look at this on the I just picked the SPY ETF. SPY, we have 100 shares. So on December 31st, 2019, it was at $318.58 a share. It looks like it bottomed out on March 16th of 2020 at $228.80 a share. So we convert those 100 shares, and so we'll pay tax on $22,880. And then I took a look at September 1st. It was at $350.72 a share, which is higher than the December value. So the value would be $35,000. And so this example here, we just made $12,000 tax-free. So the market volatility can be your friend. So we can do this if it's in an IRA account. Can't do this in a 401k. You don't have that much flexibility in a 401k, but you certainly have this flexibility in an IRA account. So market volatility could be our friend. Now, when it comes to doing Roth conversions, the Tax Cut and Jobs Act has eliminated what's called a recharacterization, which I call a mulligan. No more mulligan. So if you're going to do a Roth conversion, you better mean that you do a Roth conversion. It's a one-way street. It's irrevocable. So you have to be pretty serious about it. Nothing more frustrating than finding out about a Roth conversion at tax time. I'll ask a client, what's this 1099-R about for this great big number? You know you're going to pay tax on that. So you have to mean it. So if you're going to do a Roth conversion after the RMD age, so let's say it's 72. So what that means mechanically is you have to take the RMD first, whatever that is, and then you can do Roth conversions. So you really can't do a Roth conversion before you take the RMD because you got to take the RMD first. So they're separate items. For 2020, different story. There are no RMDs. So you could take the quote unquote RMD and convert it to a Roth. Now, if you're going to do a Roth conversion, watch out for the aggregation rules. You need to add up all the IRAs. The big mistake a lot of our clients make is that, oh, I put money into a non-deductible IRA. I'm converting that non-deductible IRA into a Roth, so I don't need to pay any tax on that. That's not true. You have to look at your other IRAs. So I'll have an example of that in a later slide of why we need to be careful about that. So our most important form in the tax returns form 8606, which is where we track the cost basis of our clients' IRA accounts. That's really important. And also, in terms of taking money out of the Roth IRA, you got to watch out for the 5-year rule. The IRA needs to be open for at least 5 years. So I like to season a Roth IRA. Try to get clients to contribute to it when they can. So once the 5 years is up, your Roth IRA is seasoned. And then you can have what's called qualified withdrawals. So here's an example of the aggregation rule. So let's say your client puts in $7,000 in a non-deductible IRA, but his other IRAs are $580,000, and they came from rollovers from 401k plans. So these are all pre-tax dollars. So $7,000 might be after tax, the rest is pre-tax. So the non-taxable portion would be the 7,000 divided by 580. That's only 1.2%. So if we did a $100,000 Roth conversion, we got to pay tax on $98,800, nearly all of it. So we got to watch out for that aggregation rule. So let's talk about the clients who are perfect for Roth conversions. These are the easy, obvious clients. So those are ones with the low tax bracket now, and we expect high tax brackets later. So as we talked about earlier, the clients with the net operating losses or all those situations where they're low income or the business is down this year, or they might have business losses. Those would be the perfect clients for Roth conversions. We might even be able to do a Roth conversion at a zero tax cost. And especially if they're going to be in a higher tax bracket later. Most importantly, they have to have the money to pay the tax on any conversion. So if there's any tax due, if they got the money to pay for it, then that works out well. Now, younger clients, of course, they have the advantage of time. So they're the perfect candidates to fund the Roth because they probably are most likely to be eligible to fund the Roth, or if they have a Roth 401k at work, because they got the advantage of time. So they have more time for the money to grow tax-free. So that's where the power of the Roth IRA works out for them. Now, for the clients that we should not be doing Roth conversions for, the ones that are in the top tax bracket or a high tax bracket, or it's very expensive for them to do a Roth conversion. So we're not going to recommend a Roth conversion for someone that would push their Social Security to be 85% taxable. So that might not make sense. Or most importantly, they don't have the cash to pay for the tax on the Roth conversion. So the worst case scenario would be people who would have to take money out of their IRA to pay for the tax, and financially that doesn't make any sense. Or if you're older, the clients are older, there's less time value of money there, so it has less time to grow. Possibly we do it for estate planning purposes, but we don't get the time value of the money if they're older. Or if you know they're going to need the money, so Roth conversion is not going to make sense. So because if they need it for their retirement spending, then why pay the tax now? They can pay the tax later when they take money out of the Roth IRA. So here's some clever uses of the Roth IRAs. So let's take a look at our clients who are students, or our clients' kids who are students, like my son. His income is less than the standard deductions, less than $12,000. So I know his tax liability is going to be zero. So he's the perfect one to fund the Roth IRA. Of course, it's going to be up to their earned income. So if you make at least $6,000, you can put $6,000 in a Roth IRA. What the Secure Act changed is that for post-grad students who are receiving fellowships, now they're considered to be income for purposes of an IRA. So we can put money in a Roth IRA for our students who are going to grad school, med school, or whatever. They're not paying income taxes. Now we can put money into a Roth IRA for them because it's counted as compensation. So if your clients or people your clients know are receiving what's called difficulty of care payments. I'm in California, so those are called IHSS payment, in-home services. So they're not taxable. They're not taxable, but now they're considered compensation for IRA purposes. So again, I think funding a Roth IRA would make a whole lot of sense for people in those situations. Take a look at that. So the Roth IRA eligibility, if you're married, your income over $196,000, you really can't fund a Roth IRA. Fully phased out $206,000. Look at married funding separately. If your income's over $10,000, you can't fund a Roth. Or for singles, like our young kids who are just got out of college, if their income's below 124, they can still fund a Roth. So those make a lot of sense. So to get a qualified distribution for a Roth where it's completely tax-free, it's got to be there for at least 5 years. Or if you're over age 59 and a half, then there is no penalty on that. Or if it's received on death, or if your IRA beneficiary is deemed to be disabled, there's not going to be any penalty and not tax on the Roth distribution. Also, Roth, as long as it's been there for at least 5 years, can be used for a first-time purchase of a home. So you can take up to $10,000. So if it's husband and wife, or two spouses, that's 10,000 each. So that's $10,000 for a Roth IRA that can be used tax-free um, for a down payment towards a home. So that could be a source of funds for that. Well, what about this? Well, okay, I'm not eligible for a Roth IRA, but I can certainly add to a traditional IRA and it's not deductible. What about non-deductible contributions? Sure, you can do that. The contribution limit's the same, 6,000 or 7,000 if over age 50. There's no income limitations. It doesn't matter if you're a part of a retirement plan or not. There's no income limitations. Income will grow tax deferred, not tax free, but tax deferred. And when you take money out of that IRA, only the growth portion is taxable. And of course, the aggregation rules apply. And it's important to keep the Form 8606 up to date where you keep track of the bases in your IRA. So that's really important, especially if you inherit an IRA. It's one of the questions I always ask. When a client inherits an IRA, I ask the trustee or whoever saying, was there a basis in this IRA? Was there an 8606 in his tax return? So we take a look at that. Just like since it's a traditional IRA, it's still subject to RMDs. So let's talk about the backdoor Roth IRA. So now we have congressional blessing of the backdoor Roth IRAs. Some tax commentators were concerned about the step transaction, that you're bypassing the modified adjusted gross income limits and the step transaction. But now we have congressional blessing. Unfortunately, it's not the law. It's not in the law. But if you're a tax nerd like me, you'll find it in the footnote in the committee reports to the Tax and Jobs Act. So it's in the conference committee's explanatory report. If you take a look at the PDFs, it's on pages 114 and 116. And the committee staffers talk about backdoor Roth conversions as a normal thing. However, if you do a backdoor Roth IRA, you still got to look out for the aggregation rule, like we talked about earlier. Those same rules still apply. So how to do a backdoor Roth? You put money into a traditional IRA. For most of our clients, it's a non-deductible because people who can afford to do it are above those income limits anyway, if they're participating in the 401k plan. And then you convert that account to a Roth IRA, and then you need to calculate the tax bill for the backdoor Roth IRA. Now, for clients who have no other IRAs, no rollover IRAs, this is really easy because it's a non-deductible contribution to an IRA, so there's no tax if that's all they have. But if they have rollover IRAs, got to watch out for the aggregation rule. So let's use Joe's example here. He puts $7,000 into a traditional IRA. His income's too high to qualify for a Roth IRA contribution, and also his income's too high for a deductible IRA contribution. He maxes out on his 401k at work, and his income is too high for a deductible IRA. He has no other IRA accounts. He's been only funding the 401k. So how much tax does he pay in his backdoor Roth IRA? None. So he's a perfect candidate for a backdoor Roth IRA because he doesn't have any other IRA accounts. So let's say Joe has $500,000 in a rollover IRA funded by his previous 401k plan. So it's all pre-tax money. So what's the tax on this backdoor Roth? Well, so it's like the previous example. It's not zero. So he's got 500,000 taxable over 507. So of that $7,000 Roth conversion he makes, 6,903 is taxable. So nearly all of it's taxable. But how do you solve this aggregation problem? Well, what you can do is roll that rollover IRA back to his current employer's 401k or 403b plan. Only the rollover IRA can do that. So if you have a contributory IRA, you can't roll it back in. But if it's a rollover IRA, you can certainly roll it over to the current employer. That takes it out of the aggregation rule, so it's not part of the calculation. So you can roll over IRAs. So it reduces the balance of the pre-tax IRAs because there's no Form 5498 for employer retirement plans. That's the form that reports the balance of your IRAs. Also, if you're over 72 or 70 and a half, it also resolves the RMD issue because if you're still working for a company and you own less than 5%, so if your client works for a big company, they can still keep working past 72 and not have to take an RMD. So for clients who have IRA accounts and they're concerned about the RMDs and they're still working, roll it back. I've done this for a client where he worked for the airlines for decades and he's got a large IRA account from all those 401k plans. Then he got a job at the airport working for a contractor to the TSA. So he's the guy in the blue shirt um, uh, checking you in at the security gate. So I see him there every so often. It's just kind of fun. So he rolled his IRA back into that employer's 401k plan. He doesn't have to take an RMD. He was over 70 and a half at the time, so he didn't need the money, and that worked out pretty well. All right, let's talk about the mega backdoor Roth. And I like this better than the backdoor Roth. I would prefer this over the backdoor Roth, and I'll explain to you why as I go into this in a little more detail. So what does the mega backdoor Roth IRA mean? It means you can put up to $37,500 in a Roth, which is way more than the $6,000 or $7,000 limit that goes into a Roth IRA. Now, how do we do this? We can do this with 401k plans and some 403b plans that allow for an after-tax contributions. And so today, currently for 2020, the limit for a defined contribution plan is $57,000. So $57,000 minus the $19,500 that can go into 401k is $37,500. So that goes into an after-tax 401k. And now that $37,500 is reduced by any employer match. So the employer matches, that reduces the $37,500, or if there's any profit sharing contributions the company might make. So it might not be the whole $37,500, but a pretty good chunk of that. To see if our clients' 401k plans allow for this mega backdoor Roth IRA, you need to review the summary plan description. Review the summary plan description. And I've been collecting a whole stack of them from different companies. Some are quite easy to read, and some I notice are very difficult to read. But I look in there to see, and the document spells exactly how the 401k plan is operated in terms of how the match is computed. So I look at that too. Because for some companies, they don't care when you make your 401k contribution, they'll match whatever the match is. Some companies will only match when you're making a contribution. So in those cases, you probably don't want to front load your 401k contribution, because if you finish your 401k contribution early in the year, then you miss out on the match for the rest of the year. So it depends on the 401k plan of the company. So take a look at that very closely. But also on the 401k website, for your clients, you can take a look at the contributions tab to see what their choices are. There could be the pre-tax 401k, the Roth 401k, the bonus, how much you want to put in the bonus of your bonus into the 401k. And then below that could be the after-tax contribution, whatever the percentages are, where the limits are. And in some of the websites, there's a box in the bottom that says in-service rollover. And what that means is it takes your after-tax 401k contribution and automatically converts it to a Roth. So that can work out pretty well. So why is it better than a backdoor Roth IRA? Well, there's no aggregation rule. There's no additional taxable income, especially if you do the in-service distribution, withdrawal, rollover, whatever they call it, at every paycheck, because the money goes in, the money gets converted. There's been no growth or whatever, so there's no additional tax. However, some clients would have their after-tax 401k money just accumulate, and they make this in-service distribution or rollover later, and there could be some growth. So if there's some growth, of course, that's going to be taxable, and you'll get 1099-R reporting that. So that portion will be taxable. And I find this a whole lot easier than doing a backdoor. A lot less paperwork, a lot simpler, a lot easier, less complicated to report on your tax return. You don't confuse the IRS, you don't confuse your IRA trustee, much easier to do. How about solo 401k plans for either yourself or for your clients who are small businesses? Can I take advantage of the mega backdoor Roth IRA for a small business? Certainly. You can do it as part of a solo 401k plan, but you have to work with the plan administrator to make sure you have these features in there. Of all the companies, I think Fidelity is the only one I know of that has it for solo 401k plans. If there's other fund companies that are doing it, let me know. That'll be great to know. But I know Fidelity does it. Some other companies, I've mentioned this, and I usually get a blank stare. So take a look at the administrator, see if they can do that for you. Now, is the mega backdoor Roth IRA for every client? No, of course not. They have to have sufficient cash flow. The clients that seem to work out the best are these clients with RSUs, restricted stock units. And so they have these oversized W-2s and they don't seem to be very good at saving money. So this is another way of socking money for our high income clients. It's not going to reduce their taxes. There's no deduction for the money going into the non-deductible 401k or the after-tax 401k contribution. So it's not going to reduce their taxes in the short run, but it will in the long run because this money will grow tax-free. So this could be really good for their estate planning or future tax planning. The more we can put our clients' savings on cruise control, the more we can get them to save. So this is who it's for. So it's not for every client, but I think it's a really good tool to use. So how to do it? First, I always suggest maximize the traditional 401k because I think they're in a high tax bracket. So don't do the Roth 401k. Do the traditional 401k. If they're over 50 years old, take advantage of the $6,500 catch-up provision, and then maximize the after-tax 401k contribution. And then they can do an in-service distribution. Now it depends on the 401k plan. Some required to go to the Roth 401k. Some give you the option of going into a Roth IRA. So if that's set up, that'll be great. So what's the difference between a Roth 401k and a Roth IRA? Well, the Roth 401k is subject to RMDs. Yes, it's tax-free, but it's still subject to RMDs. Wouldn't you want the money to stay in there so more of it grows tax-free? Investment choices in the 401k are limited to the investment choices of the employer plan. So there could be some limitations. Maybe they have access to some really awesome investments. That could be good too. Question about, is there a better legal protection? Does it matter to your client? Some clients maybe, some clients maybe not. The employer-sponsored retirement plans are protected by ERISA. So it's got more asset protection in there than an IRA. The IRA is not ERISA protected. So, but the advantage of a Roth IRA is not subject to RMDs. You have a whole lot of more flexibility in investment choices, and there is some legal protection, but maybe that's not an issue for your client if they live a low risk lifestyle. So when you're setting it up for a solo 401k, you can do the mega backdoor Roth for a solo 401k. You got to design the plan with the voluntary after-tax contribution and allow for the in-plan Roth and service distributions. Do you want to do the whole 57,000 in Roth? I don't know. That's some financial planning we need to figure out for our client. And again, the issue of the Roth IRA versus the Roth 401k. So we got to review the client's tax planning to see if this makes sense for them. So there's some other considerations to think about for advanced tax planning for our clients. So when you have clients with 401k plans with employer stock in them, I always ask the question, do you have net unrealized appreciation, NUA? That would be employer stock that was used to fund a match in the 401k plan. And when you look at the statement, or you have to call the administrator, there's a cost basis to the stock. And a lot of times it could be a lot lower than what the value is. An example was a client from Wells Fargo. He retired from Wells Fargo Bank, and he just forgot about his 401k. He never touched it, never did anything with it. Then he got a letter from the 401k administrator, from the company that administers the 401k, and says, "Dear Mr. Retiree, you've got a RMD coming up," and it just works out that the basis of the Wells Fargo stock that was in his retirement plan pretty much matched his RMD requirements. So I told him, take advantage of NUA. NUA is a one-shot deal. You can't do it in pieces or whatever. So you can roll over the 401k plan. So the pre-tax portion goes over to an IRA, a traditional IRA, pre-tax IRA. The post-tax amount goes into a Roth IRA. And that was a recent change that the IRS now allows us to do that. In the past, you just got to check for the pre-tax portion and you put in your savings account or spend it or whatever. Now you can put into a Roth IRA. That's awesome. That can grow tax-free. So pre-tax goes into the IRA. Post-tax goes to the Roth IRA. The company stock, the NUA, goes to a brokerage account. So when you do this, the taxable portion will be the cost basis of the stock. So in this example here, the basis of the stock was $55,000. His R&D was around $55,000. So it fulfilled his R&D. And the stock was worth 300,000 at the time. So his cost basis is 55, the value is 300,000. Now if he sells the stock, he pays tax at the capital gains rate, which is much more favorable than the ordinary tax rate on the IRA distribution. So when you see a client with NUA, you don't want to do a complete rollover to an IRA. You take a look at all the parts there. Could be pre-tax, could be post-tax, could be company stock. Please do that, because that could be worth a lot of money, and it makes you shine as an advanced planner. So that's really important. So here's the example of an unrealized appreciation. So let's say Mitt here, he has a 401k that's worth $1 million. In that, you take a look at the statement, you notice there's company stock in there. The value of the stock is $300,000. The cost basis is $50,000. His pre-tax contribution is $400,000. That goes into a rollover IRA. The post-tax amount was $300,000. That goes into a Roth IRA. And then he pays tax on the NUA as ordinary income. That's the cost basis of the shares. Then he has unrealized capital gain, $250,000. Perfect asset for making donations, because he's got a large capital gain on this asset. So it could be a great way of funding some charitable contributions, or just pay the capital gains rate. Again, take some tax planning to take advantage of the capital gains rates. That could be at 0, 15, or 20%. What's it going to be in the future? That can go up quite higher. So here's a helpful slide here. Why 401ks, 403bs, and 457 plans should be rolled over, not left in those existing plans. Number one, you have flexibility investment choices when you roll over to an IRA account. You can pick any investments you want, not restricted to the company plan. Two, the most important thing is when it's in an IRA account, you can take advantage of the qualified charitable distribution. If you're over age 70 and a half, you can roll over up to $100,000 a year out of the IRA to your favorite charity. And most clients don't itemize anyway, so it's worth a lot more. I'm trying to encourage my clients who qualify for QCD to do all their charitable giving through a QCD. It has to go to a charity. It cannot go to a donor advised fund or a foundation or whatever. But when it's stuck in a 401k, you can't take advantage of that. Also, flexibility in distribution choices. With an IRA, you can pick which fund to take your distribution from. Maybe this fund is high or oversized or overweighted. Well, let's take it out of that fund. In a 401k plan, you have no choices. You have to take the distribution on a pro rata basis. With an IRA account, there's no required withholding. There's no flexibility in how much to withhold or whatever. If it's coming out of 401k or employee retirement plan, there's a 20% required federal withholding. Is that too much? Is that too little? Who knows? Like we talked about the NUA there, if you're holding company stock, even though you're not taking advantage of NUA, if it's still in the 401k plan, that comes out as ordinary income. So for example, I have a client who's retiree of Lockheed. So Lockheed's got NUA. He's got a bunch of Lockheed stock in there. So he gets a 1099 for the R&D. He gets a separate 1099 for the dividends that are paid by the company. That's all ordinary income. Now, what if you roll that over, roll that out to a brokerage account? It'll be in a brokerage account. The dividends will be qualified dividends, which is taxed a lot more favorably than ordinary income. Really important consideration to think about. So the other, not just Roth conversions, I think capital gains harvesting is the thing to do for 2020. Again, you look like an advanced planner if you talk to your clients about that. Capital gain harvesting. It's not going to get any better than this. Capital gains rate is as low as it could be. So it could be the year to do it. Taking a look at your client's situation, they might have lower income this year. Maybe instead of a Roth conversion, we harvest capital gains instead. Take advantage of either the 0%, the 15% bracket for capital gains. That might be worth doing. So and there's no wash sale rule for capital gains. If you really like that position, you can sell it and buy it right back. No wash sale considerations there. What are future capital gains rates? Well, under the Biden tax plan, his document says that that if your income's over $400,000, your capital gains rate is going to be 39.6%. So we'll see what happens. So we might see higher capital gains rate. So instead of taking an RMD from your IRA, maybe we'll do a capital gain instead to replace that amount of income, and it's taxed more favorably. So capital gains harvesting could be the way to go. Also, we always need to reallocate our clients' portfolios anyway, right? So this is the year for. So you'll sound a lot smarter talking about capital gains harvesting versus capital loss harvesting. I mean, that's also important too. But capital gains harvesting for 2020 and possibly 2021, we got to take a look at that. So some closing thoughts here. Thank you for sticking with me. So 2020 could be the year for Roth conversions. Take a look at your client's situation. Take a look at the candidates seem to make some sense. Do some tax planning, run some numbers, work with their tax advisors to see if we should do some Roth conversions this year. I always get the tax advisor involved because you never want to hear a tax preparer complaining about, oh, your advisor here just cost you an extra $100,000 in tax. So anyway, so let's work together as a team on that to get to our clients' goals. And take a look at our clients who have kids who are working. Of course, the kids are not going to fund the IRAs. Usually the parents are going to do it, right? But consider Roth IRA contributions for the kids. Maybe not the backdoor Roth, but the mega backdoor Roth should be considered. Take a look at that. Take a look at capital gains. Take a look at our client situations. See how we can simplify their lives and help them reach their financial goals. So thank you for your time. I'm going to stick around for some question and answer. You can contact me through LinkedIn here. I love speaking about tax. I love talking about tax. So if you want to hear me speak again, please reach out to me. Thank you for your time.